After a favorable unemployment rate print on Friday, the S&P shot up 65 basis points to new all-time highs. Now, what's next in store for investors? With even more important economic data releases coming this week, the S&P at crucial technical levels, and two significant stock trading signals I've yet to update you with, you don't want to miss this. First, let's look at S&P's price action. Last video, we discussed S&P retesting its prior all-time high back in October of 2025, and that we wanted to see prices sustain above it as it recently broke above this resistance level that is now support. Well, with the unemployment rate printing out at 4.4% versus the 4.5% consensus, that was the bullish catalyst we needed to get our bounce and even take out our prior all-time high last Wednesday to signal further upward momentum. In addition, notice we broke our resistance zone in RSI and are moving on to attempt to break above the resistance we've been developing since December 11th. From here, we want to see RSI continue to break through upwards, along with S&P's price to hold our support zone from the all-time high in October 25 to the top of our trend channel, and potentially ride up this trend line from the bottom of our triangle. With the upward break in the triangle, trend channel, and prior all-time high, we look to be setting up for a strong move upward from a technical perspective. Now, what could further drive the S&P to even new all-time highs from a fundamental perspective? Well, the inflation data coming out this Tuesday could certainly do that. As you can see, at 8:30 a.m., we will see an update on core inflation in month-over-month and year-over-year, with an expected print of 0.3% and 2.7% for the two. Should we see prints lower than that, it will likely cause the S&P to go up further, as the two factors the Fed have been most concerned about is our labor market and inflation spurred on from our economic slowdown and COVID and implemented tariffs this year. With a favorable unemployment print last week, a favorable inflation print certainly will ease investors and the Fed's concerns around the economy, so keep an eye out for this Tuesday as its pinnacle we get a good print for the S&P to comfortably go higher. The first stock I want to talk about today is Apple, the major global tech giant known for designing, manufacturing, and selling the most well-known electronics you know of today, such as the iPhone and MacBook Pro. Apple recently saw a pullback due to concerns around slowing iPhone sales in China, an uncertain artificial intelligence strategy, as well as soaring memory costs, marking a consecutive 8-day decline in its stock price. Despite the recent negative sentiment, some have a different perspective for Apple leading into 2026, such as Evercore analyst Amit Daryanani, noting some intriguing points around iPhone demand. During China's massive Singles' Day shopping event, iPhones accounted for 26% of all phone shipments, according to Evercore's report. So while the competitors Xiaomi and Oppo, that some of you may have heard of, are taking storm in China, there is still notable demand for iPhones in China, as Evercore's research suggests. Another strong point that Amit made is that when looking at memory costs, Apple's existing pricing agreements will insulate the company from near-term price increases. What he's referring to is Apple's pricing agreements with buying DRAM and NAND, the two main types of semiconductor memory used in their devices. Apple typically negotiates multi-quarter or multi-year pricing agreements with key memory suppliers such as Samsung, with prices often being fixed or capped for a defined volume and time period. This means spot market spikes don't immediately flow through to Apple's cost of goods sold. In addition, with Apple being one of the largest buyers of DRAM and NAND globally, its scale allows them to negotiate below market pricing. So in other words, any impact from increasing memory costs will not flow through to Apple's financials immediately, allowing for near-term margins to be protected. All while the US demand in iPhones have heavily skewed toward the most expensive Pro and Pro Max models, potentially lifting Apple's average selling price and boosting its margins paired with this pricing agreement insulation. Lastly, when looking at Apple's AI strategy, it can be described as more conservative than other tech companies. Instead of huge cloud AI investments or competing purely on large language models, Apple is integrating AI incrementally into core features and workflow tools within their devices. This focus being on features that enhance existing products rather than a standalone chatbot app. Now, while many analysts and industry insiders have noted Apple lags behind rivals in raw AI capability and generative power, some argue this more measured approach could pay off, especially as the broader AI market saturates, leaving the strongest of innovations to products with AI driving the demand. Taking into account all these points, Apple certainly looks like it could have a serious bull case for 2026 from a fundamental perspective. That's not the only thing pointing towards signs of a bull case for Apple. Taking a look at this RSI strategy, here we have Apple's price over the past 10 years in the top panel and a measurement called RSI in the bottom panel. When RSI is at low levels, it suggests an upward move is likely and vice versa. Here we are seeing every time Apple's RSI breached below 12.6 and crossed back above, marked with a green dot. Each one of these triggers prompted an average return of 21.2% over the next 99 trading days. And when looking at all 4 times this occurred historically, the price was higher every time when looking at the 99th trading day out. We recently had a trigger this Friday on the 9th, marking the 5th occurrence in 10 years. Now, my calculation of RSI is a bit different than, say, TradingView, because typically RSI is calculated since inception of the stock. I'm starting my RSI calculation just over 10 years ago, which prompts for more extreme variations in value. However, the calculation is correct and still has the same implications of price momentum as if I were to start the calculation at inception. Taking a closer look at the reactions to those triggers, on the x-axis we have trading days out from the trigger, and on the y-axis we have cumulative percent change over the time frame. In other words, what you're viewing here is what your returns would be if you had bought Apple on each of the trigger dates and held for 100 trading days, or roughly 5 months. The blue line is the average return across the 4 historical triggers, in which you can see it lead up to that 21.2% on the 99th trading day. When taking a look at drawdowns of the prior reactions, we saw prices as low as 5% from the trigger price. Also notice in the first 6 trading days, our average dips to negative 2%, suggesting we could see slightly lower prices the next week before Apple goes on to trade upwards. It is important to note that these triggers are not a guarantee that the price will go up, but a good historical reference of what is realistically possible for Apple to do over the next 5 months. Now, taking a closer look at Apple's price action, I plotted out what that 21.2% average return would look like, prompting an upside target of $314.44 a share at around the start of June, and with a downside risk of 7% or $241.16 a share to respect a 3-to-1 ratio. Many investors like to structure their stop loss a third of their expected gain, so they only need to be right 33% of the time to be profitable. Notice we are currently testing our prior all-time high in December of 2024. Whenever you have breaks above all-time highs and then it holds that all-time high as support on the throwback, it's generally a very bullish sign and marks further bullish momentum back up to that new realized all-time high, if not past that new realized all-time high. So if we continue to see the price pivot upwards from here, this could be a very good sign for the bulls. And in addition, notice we have a potential bullish divergence playing out in RSI, where price lows are higher, but RSI lows are lower at the contact points of support. With us realizing a V in RSI on Friday, this could mark a potential pivot point of support. Also notice we are at support from the low in RSI on March 13th of last year, in which when we last bounced off this level, the price rose about 8% over the next month of trading days. We have a confluence of supports, which would make the support stronger. Should we break below the bottom of the support, this implies we go on to test our lower support zone at $247.72 a share to $244.31 a share. Note, we did see reactions drop as much as 5% from the trigger price when looking at the reactions, so that would place it right in line with that support zone near the bottom of our stop loss level. In addition, RSI will likely break down to test that lower support in RSI at around 20 when looking at TradingView's calculation. So maybe we see prices dip down to that point later in this week if it doesn't hold here on Monday, and then go on to perform well. The second stock I want to talk about today is Carvana, or stock ticker CVNA. They're a U.S. online used car retailer that lets customers shop, finance, and receive vehicles entirely via its e-commerce platform. They also operate inspection and recondition centers, logistics, financing, and a wholesale marketplace. Carvana has dramatically grown revenues and retail unit sales with record quarterly revenue of $5.7 billion. The company achieved industry-leading year-over-year unit growth of 44%, showing how well they transformed the company from a distressed growth story into a profitable challenger in automotive retail. Since its low in 2022, it has risen over 8,000%, showing just how much the stock has been able to move over the past 3 years, and explains the insane results you're about to see from this trading signal next. Now here I have a strategy called Bull Drought, in which the indicator measures investors' ability to push new highs relative to ability to push new lows. When this indicator dips to low levels, it indicates the bears have been in control as new highs have not been able to be achieved. And when this indicator begins to climb back, it is signaling a return in bulls' ability to push prices higher, hence a likely upward move in the near future. When this indicator crossed above 25, Carvana rose a whopping 170% on average over the next 96 trading days across 3 triggers since 2021. In all 3 instances, the price was higher when looking at that 96 day out from the trigger, and our most recent 4 trigger occurred on December 17th of last year. We are currently on the 15th trading day and up about 3.78% from the trigger price. When taking a closer look at the reactions, notice that we are nearing the point in which the average return began to really pick up, highlighting some of the insane returns Carvana has been able to achieve since 2021. Now, do I think Carvana is going to rise 170% over the next 5 months? Probably not, as the returns have gradually dampened over the past 3 years as Carvana has traded higher. However, the important thing to pick up here is that based on historical reactions, we know it is likely that prices increase over the time period, and with a strong ability at that. Given that returns have dampened as each trigger occurred since 2022, I structured a target price realistic to the downside risk Carvana could potentially experience in the near future, as a 170% return would be very unrealistic in today's market condition. I plotted out a 47.5% gain relative to a 15.8% stop loss, bringing an upward target of $658.54 a share and a downside risk of $375.57 a share. Now, I chose 47.5 because this is about 60% of the last gain achieved in April of 2025 of 79%. As time has gone on, each return was reduced roughly by that amount. As I mentioned before with Apple, notice Carvana broke its all-time high on December 8th and held prior highs that occurred on false breakouts as support. This generally implies prices going back up to the new realized all-time high, if not further, as you can see that bounce has led us into breaking out of our declining resistance line on January 7th and potentially testing our all-time high. Based on our reactions, we know we are nearing the point in which upward momentum really began to pick up. A breakout to a new all-time high would certainly be a technical catalyst to that upward momentum this time around. And should we reject our all-time high and reverse downwards, this could be a sign we are going to test that support zone at $415 to $400 a share, or maybe even lower to our prior all-time high at $376.83 a share, as we have yet to see a true retest of that level after the confirmed break on December 1st of last year. And that is all for today. I hope you enjoyed the video. If you'd like to see more, please like and subscribe, and I hope to see you in the next one.